Hello and welcome to SciLux, the podcast where we talk about scientific developments and technological changes in Luxembourg, as usual proudly powered by Research Luxembourg and recording straight from the studios of RTL City. And in today's episode, our guest is Diane Pierret, who is Assistant Professor at the Department of Finance at the University of Luxembourg and a research affiliate of the Center for Economic Policy Research. Her research focuses on financial stability, and she was a student of Robert Engel, who got Nobel Prize in Economics. Diane, thank you very much for coming today.
Thanks for having me.
So we will be talking a lot about stability, financial stability. So of course, in order to jump into the subject, I have to ask you, after knowing all this about the banks, are you keeping your money in a sock at home, or are you actually putting your money in a bank account?
Oh, I'm the worst when it comes to my money. All my money is in bank accounts.
Why the worst?
Well, because usually you shouldn't keep all your money in cash. You have to invest in a basket of assets, and I'm very bad at that.
So you just reminded me, I recently had a researcher who did inequality research, and he started his research career looking at inequality in a household. So I, of course, asked him, so how was your inequality at home? And he was like, yeah. So the theory and practice don't always go together.
No, it's true. We think about others before we think about our own household duties.
Yeah, exactly. Okay, but we move on. I will just take away the private focus right now from you, and let's move on to your research. So first of all, when I was trying to understand it, I had so many different ideas which direction we could go to, because of course there's so much we kind of have a feeling we know about banking. We have the money, as you said, in the banks, and then we see the interest rates, something's happening, something's influencing our life, but then there's a lot we really don't know. It's not that something you really learn at school. Right? So I just really don't know where we're going to go with this discussion, but let's get on with it. So why financial stability? We're kind of stable here in Europe. Everything's fine.
Well, that's a very bold statement.
I was smiling when saying that.
I think actually everything is not fine is exactly when we think everything is fine. Because the next crisis is probably the one we have zero idea about. You mentioned my supervisor at NYU, Robert Engel, and he has this very nice phrase, which is the risk that risk will change. And it's exactly about that. I think our research is about risk, that risk will change. There's so much uncertainty. There are so many new developments in banking or in economy in general. We've been through a pandemic. We've been through a war, to an energy crisis. All of those have major consequences on the economy. And the banks are the plumbing of the economy. So they channel funds from the people who have too much cash to the people who need the cash, like entrepreneurs, small businesses that are creating jobs. If we lose the banks, well, there are also major consequences for the economy. So we need to understand always better how banks can better perform their primary objective, which is to do this financial intermediation of cash in a new context and with new risks that are changing.
So what can we do? Regulate them as much as possible?
Not as much as possible. We have to regulate them in exactly the right places, and that's very difficult to find. So there is a main trade-off when it comes to regulation between financial stability, but also economic growth. If you regulate too much, then banks might not be able to lend anymore. And without lending, then firms don't survive, and then you have a slowdown in economic activity, potentially jobs are lost. So that's not where you should go. So regulating too much is definitely not a good idea. And regulating badly is also not good, because there can be some unintended consequences of regulating in a wrong way, because by regulating banks, you also change incentives of economic agents like bankers or firms. And it might lead to second order effects that was not the purpose of the regulation. Intent of the regulation was to make the system safer, but it can actually make it riskier by not understanding properly how people think and how their behavior change with new constraints. And that's really the heart of my research, is to think about that, to think about how do you react in the face of a new constraint. How are you going to still manage as a banker to make money when you have tough constraints on capital ratios, liquidity ratios, for example? And how can you still make money? And this sometimes might actually lead to riskier banks.
And there are so many different strings attached all there, because as you said, I mean, we can have political changes, and it depends also very much on the country where you are, right? And tendencies. When we talk about American banks, we have completely different approach than in Europe. And of course, it's all interrelated. So you can't say, okay, we decided in Europe to do it like this, because then we will be definitely influenced by other banks, right?
Right. And we're talking about also large banks, multinational banks that have subsidiaries everywhere. So when you touch at the regulation in one jurisdiction, this has effect on the subsidiaries in other jurisdiction. And also banks are competing. So if you regulate in one place, then money can move to the other place because the other banks will be less regulated. And we also see that between banks and non-bank financial institutions that are less regulated, or with other fintech businesses. So the moment you have less constraints somewhere else and these companies can do the banking business, which is to basically take money from someone else and to lend to a third party, the moment they can do that and they are not regulated, then you can imagine that they can actually crowd out money from the regulated banks. So there's always this idea that if you regulate somewhere, you have to also think about the rest of the economy. And yeah, of course, it's tedious work.
Of course. I was just thinking that it would be good to sit next to you, an expert in cryptocurrencies, and have a discussion between the two of you, because we're talking regulation, no regulation, right? That's a completely different trend as well, isn't it?
I mean, that's also something that central banks are dealing with right now.
And you mentioned central banks. So, okay, explain to me, why do we need them actually? What is ECB? Let's start with Europe.
So the European Central Bank, it has two main missions. It had one main mission before the financial crisis, and now it has two. So the first main mission is to keep prices stable, so to maintain a stable level of inflation, and the target is 2% inflation. That was the core main mission of most central banks before the financial crisis. And since the financial crisis, and when I say financial crisis, I'm talking about the one of
exactly which one?
2009,
okay,
right? The Great Recession, that's how it's called. And since the Great Recession, now most central banks have a second main mission, which is to preserve financial stability. They deal with these two missions, and they have different tools, conventional monetary policy tools, to fulfill these two main missions. For keeping price stable, so that's typically conventional monetary policy. That's what central banks have been doing for decades, even centuries. They change their main interest rates. So there are several key interest rates at which banks can borrow and lend overnight. And the ECB is basically managing those rates, so increasing or lowering them. This will have an effect on banks and how banks are going to pass on these interest rates on to their customers. So depositors get an interest rate when they have deposits at the bank, but also borrowers, when you borrow from the bank, you're going to get a different interest rates, which is actually reflect the monetary policy rates.
But then, as you said, you have the national central bank, and then you have the kind of, European central bank. So how does the policy travel, let's say? How much related are the decisions between the European central bank and, let's say, Luxembourgish central bank, or any other you could think of?
So the monetary policy is common to all nations that are in the Euro system.
Yeah. Eurozone.
Yes. Yeah. But who is sitting on the board are also people who work at the national central banks. Of course, there is nobody who has only European citizenship. We all have another citizenship, right? I mean, maybe one day we will all be European citizen, national citizenship will not matter. But nowadays, there is a balanced group of people deciding, and most of them come from the national central banks. The ECB worked together with the national central banks to define what are the next monetary policy decisions.
And I want to now look a little bit more on larger banks and to look at stress testing that I know you also looked closely at. But before we do that, I mentioned larger banks. So I know you prepared some pub quiz question about one of the banks we know very well, I guess. And yes, if you could ask the question and then listeners remember, the answer will be only at the end of the podcast.
The large bank I'm thinking about is actually the second largest bank in the US, Bank of America. And Bank of America used to have another name before 1930, which refers to a European country. And guess which one and for what reason?
So remember, answer only at the end of the podcast. We will be revealing that and talking a little bit more probably about Bank of America. But before that, as I already signaled, I wanted to look at stress testing. So it's one of those things I have to say when I watch the news or read the news. Okay, they talk about interest rate, inflation, and then you have some stress tests. But what are they actually?
So this is something also new, I mean, an innovation of the financial crisis. Many ideas came about how should we better regulate and supervise banks and mostly the largest banks, because we think of them as systemic banks. I mean, banks that pose a systemic risk to the economy by the fact that if they fail, there will be major consequences for the economy, not only on the clients of the banks, but outside for other banks and for the economy in general. So these banks were really in the radar of the regulator at the time. And yeah, they came up with different ideas, different tools that they formalized in some new regulation after the financial crisis called the Dodd-Frank Act. The tool that after Dodd-Frank Act probably constrained banks the most is stress tests. So what are the stress tests? Banks were actually performing themselves stress tests as part of their own risk management before the financial crisis. But that was really their own initiative and it was not that regulated. After the financial crisis, we realized that we wanted to have a common basis to assess banks in the face of a severe adverse economic scenario. It's actually funny because stress test is not coming from banking. It's coming from engineering. And I mean, you try to push as much as possible the conditions so that at some point you see where the material break or something like that. In banking, it's basically the same idea. You have a very stressful scenario, an adverse scenario where you have GDP going down by X%, unemployment is also increasing. Many factors are changing, and you see how the asset values would change. Of course, prices of most assets will go down, which means the bank is making a loss. And this loss has to be absorbed by equity capital, such that the bank can still repay depositors. And if the bank doesn't have enough equity, then it doesn't pass the stress test. There's this idea that we assess the sensitivity of bank assets to this stressful event. And if the bank has risky assets on its balance sheet or assets that are not properly accounted for, this will actually show up in the stress test. It will show up as a loss that has to be absorbed by equity. And if the bank doesn't have enough equity, then also it will not pass the stress test. So there's these two factors that make banks very sensitive to a stress test. One is the riskiness of the assets on the balance sheet, and the other one is how much equity they have as a proportion of the total balance sheet. And I think it's actually an incredible tool, not only because you assess values of assets and so on, but because regulators collect a lot of information. They know way better now than they used to know before the financial crisis. First of all, what banks have on the balance sheet and how to price the assets on the balance sheet. They collect a lot of information about the single asset exposure over time to understand how the prices of that class of asset, for example, changes with different factors like interest rates, sovereign risk, or any other potential factor. Now, the issue also with stress tests is the same as I was mentioning before. They don't always capture the risk that risk will change because we think about scenarios that happened in the past. By definition, we're not necessarily thinking about an energy crisis when you are in 2019. This is not something that we could imagine at the time, and this was not in the stress test. Or thinking about an increase in interest rates, also in 2019, this is not something that was in the mind of the regulators. So they are not so forward-looking in a sense that we're looking at always at past scenarios. But this is one tool that is still very useful because even if the scenarios might be wrong, we collect a lot of information about the bank. In the US, the stress test was so invasive that there was also a quality exercise which was there to assess the risk management team about how serious they are in doing their job, all the assumptions they were using in their models, whether they were challenging these assumptions to see, is it because the model works like that, or is it because you have actually an economic reason to think that this parameter should be that value, and so on. And that also had a lot of value, but it was very constraining for most banks. And when the financial crisis was a bit far in the past, we started thinking, wait, maybe this is too much constraining for some banks, especially banks that are not the largest of the largest, but a bit below. Maybe we should start reducing the burden. And this is what happened in 2018. We started reducing the burden for not the largest banks, but banks that were under some threshold. And that coincides with some of the community banks that failed this year.
And then when it comes to stress testing in the US and stress testing in Europe, because you said, Dodd-Frank Act, that's an US act. So how much was it influential for European stress testing?
Okay, so Europe also started with stress tests early on, already in 2009. And then it evolved a lot because there's been changes in the regulatory institutions. There's been a more and more consolidation at the European level. So different institutions got involved. For all the time, you can see that the European Banking Authority was involved in this. It had a different names before. The European Banking Authority followed a little bit the same idea, but with different resources and also with different political backup, I would say. That's very important because you have to think that when you announce that banks would fail under a stress test, under a stress scenario, this is pretty bad news. Mm-hmm. So you have to come up with a plan. And in the US, the first stress test in 2009, it was pretty explicit that they would go under severe stress test. So the banks under the radar would go under a severe stress test. So some banks would fail. There would be some capital shortfalls. But if the banks would not find the equity capital on private markets, then the government would step in, would buy equity. This was not possible in Europe. It was not possible for the ECB at the time to say we're going to buy equity stocks at a bank in Spain or a bank in Ireland. It was not in the mandate of the ECB. So what can you do when you cannot announce that plan? Well, you do a milder stress test. So everybody passes. And, it's not very credible, when when you have a class of students and everybody has the best grade, that there is something that was not done properly. That was the main issue with European stress tests is that they were considered much milder than the US ones, and therefore also the credibility of these stress tests were not so good. So we could see that at the announcement of stress tests, at the disclosure of stress test results, there were even worse market reactions because basically the market, the investors understood that there would not be severe recapitalization plan for the European banks. I think that also contributed with events that followed up in the fact that the European banks were not recapitalized as much just in the aftermath of the financial crisis compared to the US one. So we saw very different trajectories in the profitability of US versus European banks after the financial crisis.
You mentioned that we saw some banks failing recently, and you also mentioned the fact that sometimes we kind of know what could happen, and sometimes we just can't predict because it's going to be some new crisis. So is it possible to give a ratio? If we hear about a bank failing, is it more often because it's a completely new, unpredictable thing, or is it because at certain level people did not really do their jobs correctly? Like when we look at Silicon Valley Bank, I was just wondering, I mean, there was concentration risk. Mm-hmm. We can clearly say most probably a bit risky to start, but still people kind of let it be for quite some time. So could this be something that just certain regulators, I don't know, investors ignored, or is it something that we could not predict?
So I think there's a little bit of both. In the case of Silicon Valley Bank, it got deregulated a few years before. So in 2018, this idea that stress test was actually very invasive, especially for the banks under some size threshold like Silicon Valley Bank, became very prominent, and banking lobbies became more and more powerful. And that's a manifestation of what we call the regulatory cycle, in the sense that in a financial crisis, there's more and more resources put in regulation and in regulating banks, and you come up with strict rules and so on. And then once the crisis has faded and there is economic recovery, then we pay less and less attention on banks, and we start thinking, oh, but after all, now the banks are stronger, they're doing good job, so let's deregulate, we don't need as much. So this is exactly what happened in 2018. It started actually in 2016, but in 2018, the Federal Reserve decided that they would no longer impose a stress test to banks under size threshold. It was $250 billion. And Silicon Valley Bank in 2023 had $200 billion of assets, so just under the threshold.
How convenient.
How convenient. So that's where I would say that's a little bit of discretion from the regulators, bankers, banking lobbies, I don't know. But here there is a clear mark that at some point there was a big political will to deregulate banks under a certain threshold, and Silicon Valley Bank was one of them. Now, about concentration risk, it's true that Silicon Valley was very concentrated, not only on the asset side, but also on the liability side, getting deposits that were large and all coming from one region, Silicon Valley, and one sector, the tech sector. And there's not much in terms of regulation. So it's maybe something we didn't think about before, or maybe we're more focusing on the imminent risks, or by definition, we always concentrate more on the asset side of banks and where the risks are on the asset side. And we forget completely about the liability side, because as long as the bank has enough equity, why should we care? And here, I think the concentration risk in liabilities is something that is not so much regulated. Of course, you cannot have large exposure to a single counterparty. That's regulated. But the moment you have many counterparties that are exactly the same, they face the same risk, they are in the same region, in the same sector, it's clear that they are going to be affected at the same time, which poses extra risk on the liability side of the bank. If you had diversified depositors, then when one sector, one region is hit, okay, that depositor takes away the money, but the other depositors stay. While if you're exposed to the same shocks at the same time, everybody will want to run. I guess this is one of the reasons why Silicon Valley Bank failed. I mean, you can say that this was predictable, but maybe ignored, not necessarily voluntarily, but because of lack of attention to this point. Another thing that could not be predicted is why this region, this sector would go wrong. I think that's also something that was not necessarily predictable.
Of course, that's in general the problem of risks. When, you go into the descriptions of risks, they are again kind of like what you were saying. It's the past experience, right? Suddenly China risk is 7 pages because, well, we had experience with certain investments there, right? But before, it's not going to happen most of the times. It's so difficult to predict the market, I guess, in that case.
And again, coming back to the size threshold, it's not clear where you should put the bar, because it's true, we believe that it's the largest banks that pose the most risks to the economy. But if you have a lot of small banks and they all are connected and they're going to fail at the same time, this can also create major risks. So it's, again, part of the trade-off between financial stability and economic growth. You want to regulate, but not too much. And who do you regulate, again, makes a lot of difference.
Yes, and also another thing that I did not know about was the insurance of deposits. So that's kind of something that plays a part, right?
Right. So, I mean, this dates back from the 1930s.
Okay, so I should have known. I had enough time.
But that's maybe why we don't know, because you were not born.
Yes, most probably not.
Most probably. Banks are a very special type of business in a sense that banks collect deposits that are very short term. So you can go anytime at the bank and withdraw your money. And at the same time, the asset side, the loans are long term. You make long term mortgage loans, sometimes over 30 years. So you see that there's liquidity transformation, which is the core business of the bank, which is to collect short-term deposits to lend long-term. And that, of course, can pose problems, because once you have too many depositors who want to withdraw their money, then you cannot sell the assets because they're, by default, they're not liquid. They are very long-term assets. Yeah, so that's something that has been formalized. The idea that you could have bank runs and that once significant fraction of depositors start withdrawing, other depositors are also going to want to withdraw because they can predict that the bank is going to fail and they will not recover their money. This is something that has been formalized by other Nobel Prize winner last year, Diamond and Dybvig. So they have this 1983 paper that actually formalizes this idea that banks are subject to runs and that deposit insurance can help a great deal to actually dampen this phenomenon of self-fulfilling runs, where actually, because you think that other will run, then you run yourself because you're afraid you're not going to recover your money. And the solution to that is to say, well, we're going to insure deposits. We're going to make sure that you recover your money if the bank fails. So you're not willing to run anymore. You're not willing to go withdraw when you see other withdrawing as well.
But they are not all insured.
Not all. So there is always a limit. There is a limit. I think it was $2,500 in 1934.
Okay.
So when this was actually introduced. And it became 100,000 before the financial crisis. And during the financial crisis, they raised the FDIC limit was raised to $250,000. Again, to mitigate the potential of bank runs that are not necessarily based on the quality of the bank fundamentals, on the asset values of the bank and so on, but more the idea that I will run because I see others running and I'm scared of not recovering my own deposit. And this is something that's been generalized to almost all countries. Luxembourg as well has deposit insurance. So, that 100,000 euros is insured in a Luxembourgish bank. So if a Luxembourgish bank would happen to fail, you would recover up to 100,000 euros.
And that's the state insuring, or
yes.
Where does the money come from?
It comes from the state, yes. Mm-hmm. It's government insurance, yes.
Okay, well, at least it's not a percentage of already my small amount of money in the bank. Just wondering, I do have this tendency. I just recently kind of applying for a mortgage. So there was a lot of calculations and interest rates and whatever. So when I hear banks and money that I need to give somewhere, it's getting me stressed, I have to say. But I guess that's a classic approach, I would say, to most of us. Yes.
But this deposit insurance is actually something that paved the way to many other problems in banking, actually.
Really?
Because it distorts also the incentives of depositors and bankers. Because you know that the money is insured, then you don't pay attention anymore about what the bank is doing on the asset side. Right? Bankers, they don't care because it's not their money. They don't even pay for the deposit insurance themselves. So then you're what is called moral hazard happening at the bank, which means that, well, you're focusing on the states where you're actually going to make a lot of money. So you're taking additional risks compared to whether it was your own money at stake, right? And that's how it actually paved the way for capital regulation. Because more and more banks were using very little equity, being over-leveraged and investing in risky assets. And this is how you have additional banking crisis coming on later. And that's why we had the Basel Accord later on with capital regulation to actually make sure that the banks keep enough equity capital to cover asset losses in case these losses happen. Again, this is an example where one regulation distorts incentives and calls for more regulation again. And
vicious circle.
This is happening with everything. Each time there is a new regulation, new type of supervision, there's plenty of research papers that are written because there are so many effects that we might not think in the first place.
So that's actually good for you because more regulation means you can also write papers about them.
More or less regulation, anything that happens in the banking industry, banking crisis also. I mean, since the financial crisis, banking is a field in finance that has increased a lot. A lot more researchers have started writing papers on banks. Yes.
Of course, that's good news in a way, but in a way, at least for you, looking at it from your personal, coming back to the personal perspective. Yes. When we were preparing today for the show, you sent me a huge list of different possible pub quiz questions, and we chose one. But there was also another subject that kind of got me interested because we have had a discussion here once in a while with our guests about the situation of women in academia, of course. And, I'm trying not to turn it into a female podcast, I have to say, but sometimes it's something that I just really want to discuss because there might be people who don't know about it. So you told me that the number of women in banking research is very, very small.
That's true. There is an association now that is in place to promote gender diversity in academic finance profession called AFFECT. And it's an association of the American Finance Association. And they do regularly surveys to check statistics because we always hear, it's 5%, it's 15%, it's 20, 50. We don't know, basically. We don't have the data. You can always go on websites and look at pictures and you can figure this out. But they collected data. They sent a questionnaire to 127 business schools in the US. I think half of them responded. And among those who responded to the questionnaire, they found out that among all faculty in finance departments, 20% on average were female professors. And it goes even worse when you look at tenured faculty. So these are professors who are tenured, they have a permanent contract, they won't have to move after a certain period of time. And there the fraction was 16%. Now, if you move to top business schools, it gets even worse. So it goes from 16% to 13% of tenured female faculty. And this is an average. So, of course, you're going to have lots of departments that have 0 women. And in general, it doesn't go to 50%, I can tell you. The maximum is not 50%. So it's rather low, yeah.
Now we don't have the study about it, but I'm just going to ask you for your own personal opinion. Why is it like this? What's going on there? What's behind the scenes? Give me a scoop. No, joking. Don't tell me because I guess you want to keep your job. But anyway, just out of curiosity.
I think we lose a lot of female finance scholars after PhD. So there is more and more females doing PhD in finance, which is great news. But when it comes to career perspectives, going into academia in finance can be difficult, especially if you want to have a family. And that's probably something that is there for all fields in research. You have to move a lot. In our case, we have to go on a centralized job market that happens once a year, where you interview for more than 100 schools, and then you have no idea where the next year you're going to land. And that's a possibility to have an academic job. So you cannot choose where you're going to work. Maybe what's particular also is the culture of the profession. And that's also the case in economics, in finance, where we have a very aggressive type of culture when it comes to communicating about research. So when you go and you apply to a job, you have to give a seminar about your paper. And it can be very aggressive. It's like taking bullets on you and being able to reply to these questions. Like, you can start the first line and talk about what your paper is about, and someone is going to ask, but why should we care? And this is sometimes very intimidating for some of us. So you have to be able to deal with that and build a thick skin and not take all these things personally, obviously. And then there is also lots of troubles. And I think that's different from other fields in the sense that we have to go on a campaign about our paper before we even start submitting to a journal. So we have to go to many conferences, meaning lots of travels. Every year is like how many conferences are it's always more than 10 conferences. It is always some time in the month where you have to travel. Most of the time it's to the US. And it's getting better because those conferences organize childcare and so on. But you can imagine that's not the ideal life of someone who is a woman who's in her 30s, and she has to deal with strict deadlines, travels, and a lot of pressure to publish in those years because you're on tenure track, and you're going to be evaluated in not every year, but in 6 years from now. And you have to publish in finance journals that have a 5% acceptance rate. So
it's a miracle you found time to talk to us actually today, really, because looking at that, you have absolutely no time left.
I'm happy to come here because that's part of our duty also to society, is to talk about what we do and to explain. It's actually very difficult to explain what it is, what it means, to do research in finance. So I think it's also very important to communicate about it.
Okay, good. You have that approach then. Will not help you with the next paper, unfortunately. No, I will not help you publish. But who knows? Yes, maybe, who knows? Someone is listening who is going to be like, yes. All right, yes. But anyway, it was very, very interesting, and I just wanted to touch upon that. And as I mentioned, the pub quiz question, I think it's a slowly moment to wrap up. So go to the real pub quiz question. So not the second one, let's say, but the first one. So if you can just remind us what the question was and then give us the answer.
All right, so I was talking about Bank of America that used to have a different name before 1930. It was actually Bank of Italy.
Surprise.
Yeah, exactly. So I was actually very surprised myself when I checked on this fact. It was actually a bank founded by second-generation Italian immigrants for Italian immigrants in California who were facing some discrimination in the types of services they had access to. And then Bank of Italy acquired or merged with a bank that was called Bank of America, a smaller branch. And so 2 years later, Bank of Italy changed its name in 1930 to Bank of America.
Good for Italy, because it would be very confusing if there was a Bank of Italy in the States, right?
Right. Because the Bank of Italy is actually the central bank of Italy.
Exactly. They would have to change the name or something, right? To know how it goes. But yeah, this is a very, very interesting fact. Also because Bank of America is, as we said, is it the second largest in the States?
Right.
And the first one being?
JP Morgan.
JP Morgan, yeah.
Yes, with 3 1.6 trillion of assets. I mean, these are very big numbers, like with 12 zeros. So it's really, really huge.
Yes, exactly. So very interesting fun fact. We also agreed that it's interesting privately for us as well. So the Italian connection, right? But anyway, thank you, Diane, so much for coming today and telling us a little bit about what you do. And hopefully we will have a chance to host you once again in the near future.
Thanks, Hannah. Thanks for having me, and thanks for your questions.
Thank you. This is it for today. Of course, don't forget to subscribe, to follow us, to check what we're writing on Twitter, LinkedIn, Instagram, Facebook. And of course, you can find us wherever you get your podcasts. This was SciLux, and my name is Hanna Siemaszko.